I'm Dave Mecklenburg. Welcome to another Festival of Traders event. Before we begin, I want to remind you there's a high degree of risk in trading. If you've been trading for more than one day, that you know that you can and will lose money trading. Only trade with money you can afford to lose. Our guest today is the author of 2 books on trading commodities, Commodity Options, and a trader's first book on commodities. You can find her at decarlytrading.com. Please welcome Carly Garner.
Thanks, Dave. It's a pleasure to be here. I appreciate the Festival of Traders and everything they do for the trading community. Today we're going to talk about the COT report, or the Commitments of Traders report. It's issued by the CFTC. We actually look at the COT report quite often in our market analysis. In fact, if you watch the show Mad Money on CNBC at all, we every once in a while will go we'll contribute content to the show and charts and where we actually take a look at the COT report and some of the things that we're seeing in the commodity markets and that sort of thing. Anyway, so let's get started. As a quick overview, we're going to talk about what is the COT report, how's the data collected, when's it released. There's a couple different formats, which makes things probably a little more complicated than they need to be. So hopefully we can simplify that a little for you. And we're going to basically, the idea of looking at the COT report is to identify overcrowded trades. We want to see, if a market is really overheated, and if it's overheated to the point where the buying might dry up or the selling might dry up, or simply, markets don't go up or down forever. We all know that. There's going to be peaks and valleys, and so the idea of a COT report analysis is hopefully to try to identify where those peaks and valleys might be. As Dave mentioned, there's a substantial risk of loss in trading commodity futures, options, forex, you name it, there's risk. It's not suitable for everybody. We're going to talk about some historical examples of the COT report and how they helped to predict some price movements, but of course, past performance is not indicative of future results. Just because something worked once doesn't mean it's going to ever work again. And once again, my name is Carly Garner. I'm a broker for DeCarly Trading in Las Vegas. And we handle futures, options, and even Forex. If you're on the social media scene, you can catch us on Facebook or Twitter. The symbol, or I should say handle on Twitter, is @CarlyGarner. And feel free to visit our website, decarlytrading.com. There's several free trade and videos, and hopefully you can find something that helps you in your journey. Just a little bit about me. I'm a broker, an analyst, and an author. As Dave mentioned, I've written a couple books, but I've also I write a monthly column for Stocks and Commodities magazine, and I write a couple of newsletters that DeCarly Trading brokerage clients receive free of charge. If you're interested in any of the books I've written, the most popular is the Trader's First book on commodities. It's kind of a grassroots effort on getting started in commodities. I'm actually working on a 4th book as we speak, which will be more of an intermediate to advanced commodity trading book. Okay, let's dive in. The COT report is similar to the SEC's insider trader filings. It basically tells us who's buying and who's selling and to what degree. In my opinion, it's the optimal gauge of market sentiment, because we're not talking about what people think the market's going to do. We're talking about where people are actually putting their money on the line. They're putting their money where their mouths are. The COT report is issued by the Commodity Futures Trading Commission, and they put it out on a weekly basis. It's basically a snapshot of the open interest on U.S. futures exchanges, and if you're not familiar with open interest, don't feel bad. It's kind of a commodity market term. Not everybody's been introduced to it. It's basically the number of futures contracts that are held overnight. So the important thing to note about that is it's going to include, or it's going to exclude day trading activity. So, all those thousands of people buying and selling even the S&Ps intraday do not even show up on this report. Another thing to keep in mind is the COT report is measured on the close of business on Tuesday, and it's released on the following Friday afternoon. So once it's released, it's already somewhat stale. But you can kind of look at things and see where the market's gone since the Tuesday reporting and kind of get an idea of maybe what the current picture of the COT report might be, and you can make some inferences. And we'll show you some examples of that a little later on. Before you can really understand what the COT report is and the value that it offers us, it's important to kind of understand how it's created. It's in the simplest explanation, it's basically this. The clearing members, or the FCMs, and even foreign brokers, file daily reports with the CFTC that depict their clients' holdings. The CFTC has what are called reportable limits. If any of the trading accounts at a brokerage firm are at or above the CFTC's reportable limits, those accounts are reported to the CFTC. It's not a bad thing if you're reportable. In fact, if you're trading enough volume to be a reportable, congrats, you're trading pretty big size. It varies from market to market. Somebody to qualify to be reportable in the E-mini S&P would have to be a massive trader. But if you're trading something a little, less popular, let's say the dollar index or cotton, you actually, some of the average retail traders might every once in a while fall into that category just because of the lower volume. I've had, just to give you an idea, I've had in the past people trading options in thinner markets that have a 20 lot on and they actually qualify for being a reportable, just simply because that particular option market and strike price had nothing going on in it, and so the CFTC had low limits. So I just want to make sure you understand that the limits on every market vary based on that commodity's liquidity. The group that's known as the reportables, and these are typically the big guys, the smart money, the deep wallets, they usually account for about 70 to 90% of all open interest in the futures markets. The COT report basically breaks down the open interest into 3 categories. Well, I should say they break it into 2 categories, the reportables and the non-reportables. Remember, the reportables are the big guys. The non-reportables are people like you and me, the small speculators. The reportables are actually then categorized as 2 different types of market participant. They're either non-commercial or commercial. An easier way to describe them is a large speculator or a hedger. So commercial reportables are businesses that are basically trying to shift their price risk through the futures markets. They're hedging. And the non-commercial are the large specs. They're the hedge funds. They are the, the rich guy speculating on gold. But they're the smart money, or so-called smart money. So which group should we focus on? I like to focus on, I actually look at all 3 categories, but the first thing I look at is the reportables non-commercial, in other words, the large speculators. This group is dominated by CTAs, commodity trading advisors, and CPOs, commodity pool operators. They're considered the smart money, as we've already mentioned. In my opinion, this is the group that you should pay the most attention to. They must have done something right to get to a point where they could trade enough size to be considered a large spec, but keep in mind, these guys have deep pockets, so simply blindly following them is suicide for the little guy. You don't want to just follow the smart money and think you're going to make money, because sometimes they're early, sometimes they're late, but it doesn't matter as much to them because they have the money to just simply ride things out until they're finally proven right. A group that I rarely make many decisions on in my trading, or at least, I don't put too much emphasis on them, is the commercials. These are the people that are using the markets to hedge. It represents end users or producers of the underlying asset. They are not trying to make money. They are simply hedging their cash market risk. In fact, they're probably making money in the cash market and losing in the futures market. So do not follow this group. And the third group is the small speculator, or the non-reportable. I love to watch this group of traders, not necessarily because I feel like they're setting a good example, but maybe it's almost the opposite. Some might have harshly called them the dumb money. I don't think that's probably a little harsh. But the bottom line is the small speculator is they're extremely fickle. They're usually funded on shoestring budgets. So in other words, they might be the guy trading one corn future in a $2,000 account, and they have little room for error. So what happens is they're forced out of positions early. They don't really have the opportunity to give the market time to play out, that sort of thing. So what we like to look for is an excessive position in the small speculator group, because we know that if something goes wrong, they're really quick to cover their position. And if they have a big enough position, when they cover their position, it can really move the market. And another thing to keep in mind is a lot of times people will look at the small specs and think of it as kind of a contrarian indicator, because unfortunately it sounds cruel, but the reality is most retail traders lose, and most of them are wrong in the direction. Here's an example I just wanted to kind of show you the difference between different market sentiment and extremes. This is actually an example of an overcrowded euro trade in the spring of 2011. This is the, if you notice this green line down here, that's the large spec. The small spec is in blue. And then the commercial speculators or the hedgers are in red. We're paying attention here to the green line, which is the large spec. And what we see in this is, at the time, believe it or not, that 100,000 net long contract position, if you, just as a quick FYI on how to read this chart, what we're looking at here is you'll notice there's, on the right axis on the lower section, you'll see a 0 in the middle, and then you'll see 5,000, or I'm sorry, 50,000 and then 100,000. That's basically telling us what net position the speculators have. So in this particular instance, you'll notice in May of 2011, the large speculators were holding a net long of 100,000 contracts. At the time, that was actually the biggest in history. I think, if my memory serves me correctly, I think it got up to about 130,000 net longs, and that was the most we'd ever seen in that particular market. So at that time, we thought, hey, you know, all the hedge funds, everything is basically, they've blown their wad. They probably don't have much more money to spend. And at that point, the buying dries up, and what happens? Prices reverse, because if all the big guys are already in and they've already pushed prices to the limits, sometimes it's hard for markets to keep those lofty levels if there's nobody left to buy. It's really as simple as that. Now, in contrast to 2011, in early 2015, large speculators were actually net short the euro. In fact, they were so net short, they were holding somewhere around, if I remember right, somewhere around 260,000 contracts short. Now, if you remember on the previous slide, I just told you the biggest net long position in history was about 130,000. Well, the bears really, really got out of hand in the euro, and you know, as we know, there wasn't a time that during that early 2015 period you could turn on the TV and not hear something about the roaring dollar or, you know, the euro being in the crapper. And so here it is. This is what happens is everybody gets really bearish and the markets get really short, and particularly the big specs that they've made money all the way down. They just keep loading it on, and eventually they get to a point where they run out of money, or they're just really not willing to sell more. And then what happens, eventually they have to cover their positions. To cover their positions, they have to buy contracts back. So regardless of how crappy the fundamentals might seem at that particular time, if everybody's already short, there's nobody left to sell. And those people that are short, there's only one way for them to get out of the market, and that's to buy. And so what you see is a quick reversal. And we saw that right here. The euro went from 104, or $1.04, however you want to say it, to about $1.17 in pretty short order. So this hopefully just gives you a good idea of how the markets work. Sometimes when markets look the worst is actually when maybe they're the best play on the board for a contrarian play. Okay, many people ask me which version of the COT report should they be looking at. And well, let's just summarize things like this. The Commodity Futures Trading Commission is a government agency. Governments tend to make things a little more complicated than they need to be. I think we can all agree on that. So the COT report is not anything different. It's just typical of what you see from a government report. There are multiple versions. There's a short format and a long format. The short format is the most common. It's the one, if we scroll back to those charts we were looking at where it has the 3 lines, the large specs, the small specs, and the commercials. That's the short format, 3 categories that we've already talked about. The short format is going to tell us the net change in net position, the number of traders in the net position, and the percentage of open interest by category. The long format is going to give us some additional information. It separates data by crop year if applicable, like for the grains. It shows a concentration of positions held by the largest 4 to 8 traders. In my humble opinion, I think that all of the useful information that the COT report provides is probably in the simple short format. But you know, everybody has a different idea of what works for them, and if you can find some sort of edge using the long format, then that's good too. I just haven't been able to really find it. There's also, the report not only comes in long and short format, but it can be either futures only or options and futures. The futures only report represents the net long and net short positions in each category. The options and futures version accounts for the net option position in addition to the net futures position. So for example, the net option position is determined by the delta of the holdings. So for every trader that is long a call, his position is adding to the net long calculation, while anyone that's short a call would be adding to the net short. Now the degree, it's not a one-for-one ratio. It's not any person that's long a call option is going to count as one net long. It's based on a ratio of delta, and that's the rate of change in option price relative to futures movement. So for example, if an option delta is a 30%, the trader is net long 3/10 of a futures contract. It's a little more complicated than most people want to realize, think about, but the way that I look at it is keep it simple, stupid. For simplicity, I believe the short format of the futures only is probably optimal for most traders. Now, with that said, honestly, I probably look at the options and futures version more often than I look at the futures only. But the truth is, they're going to give you pretty much the same overall picture. It's rare that you would get a completely different conclusion from the version that offers the options as opposed to the one that offers just the futures. I like to look at the option version because we do a lot of option trading, and we like to know, like, if option expiration's coming up, is there, does it seem to be the propensity for some short squeezing or some long squeezing into option expiration? But that's probably a little beyond the discussion for today. So for most of you, I'd say futures only and short format is the way to go. Okay, one of the most common questions I get is, where do I find the COT report? Well, the CFTC offers free access to the COT report right on their website. And it's pretty awesome. You can actually register to have the COT report delivered to you by email every Friday afternoon immediately when it's released. So it's a pretty cool service. The problem is it's going to look like this. And for most people, including myself who does this for a living, this is nothing but gibberish to me. It's hard to read, it's hard to really get much out of it, because the thing about the COT report is it's really only useful if you can compare it to previous periods or other markets. It's like a relative thing. If you just look at a spreadsheet like this in text, it doesn't give you much information, or at least not without doing a whole lot of work. Perhaps a better source to get it is through the Hightower report. If you're not familiar with Hightower, they are basically a subscription-based newsletter, and weekly they do provide this access to this COT report, and it says almost the exact same information. Actually, it is the same information that the CFTC version provides, but it's just so much neater, and you can see really easily, they've color-coded it to make it obvious whether people are increasing or decreasing positions. Just to give you an idea of how this works, let's look at crude oil. If you look in the third column under energies, it's the first commodity listed. It'll show a net position of 259,429 contracts. And by the way, I should have pointed out, if you look towards the top of the page, you'll see non-commercial, commercial, and non-reportable. So basically what we're talking about is the first column is large speculators, the middle columns are commercial hedgers, and those are small speculators. So in crude oil, we can see that the smart money, the large specs, they're net long 9,000 contracts, or a little more, and they've actually increased their position from last week by 20,000 contracts. We can see that in the green. And then we'll skip the commercials because, like I mentioned before, we really don't care what the commercials are doing. They're just they're hedging and minding their own business. It's really none of our concern, or at least none of mine. But if you go to the small spec, you'll actually find that they are net short crude oil, and they've added 9,000 contracts to their position. So you can tell by looking at this report, in the previous week, the small specs were basically neutral, and now they've gone slightly short. So that's, in essence, how you're going to read a COT report. Like I mentioned, this is Hightower, and it is a paid subscription, but it's probably worth it if you plan on doing any COT analysis. Now, here's an even better source. If you go to barchart.com, they offer charting of the COT for free, so it's pretty awesome. If you go to barchart.com, on the top of the page, click on the Futures tab, and then on the left-hand side of the page, look for Commitment of Traders. And when you do that, you'll be able to pull up a chart on any of the commodities that has the COT chart at the bottom. And you'll notice, again, we've got the green line, the blue line, and the red line. The green is large specs, blue is small specs, and the red is commercial speculators. And we can see right there visually, are the small specs long or short? Are they adding money? Are they subtracting money? So barchart.com is a great way to check out the COT report. Okay, now that we know what the COT report is and how to read it, or at least where to find it and how to look around, let's talk about why is it useful? Well, the CFTC's COT report can be useful in the following ways. First and foremost, identifying overheated markets. You really, really want to make sure you understand if a market's overheated. And even if you're not necessarily in the market, you don't want to get in at the worst time. You don't want to get in just as the party is ending. And if you are in it, you don't want to be greedy and end up giving your profits back because you held on too long. So whether you're in the market or looking to get in, making sure you identify these overheated markets is important. It can help you avoid being on the wrong side of mass liquidation. Keep in mind, it's not how much you make, it's how much you don't lose in these types of things. And if you're flat the market, identifying an overheated market can put you in a position where you can play offense and you can trade counter trend, and that might be, selling puts against the declining market that you think is oversold, or it might be buying calls if you think the market's too cheap. But in any case, when the trend ends, it ends abruptly, and sometimes that's where the big money possibly can be made. Of course, you always hear the opposite also. If picking a bottom can also be a challenge, but everybody has their own idea of what type of market scenarios or setups are the best. You just have to do your homework and figure out what fits your comfort level and your personality. Another way that the COT report is helpful is in following the smart money. Now, we already mentioned that the large specs have deep pockets and they can ride things out, and you want to make sure you're not following them at the wrong time. If they're getting a little too aggressive, historically, based on how long or short they normally are, that's probably not the time to start following them. In fact, you may even want to start fading them. The third reason to look at the COT report is to see what the small speculator is doing and possibly look for a contrarian indicator. Now, just like any other technical tool, whether it's seasonal or fundamental analysis you're using, or stochastics or RSI, the COT report is basically just another tool in the tool belt. It isn't the fail-safe answer to trading. It's not going to guarantee your profits. But I believe when you use it in conjunction with some of the other timing indicators and seasonal measures and sentiment indicators, I think it does improve your overall success. Okay, so let's talk about how you actually identify an overcrowded market. It's important to realize the COT data is relative. You can look at a snapshot of what the COT data is today, but it really means absolutely nothing unless you know what the COT data has looked like historically, whether that's over the last week or the last 5 months or the last 5 years. That's up to you and your time frame and your trading strategy. But you really should know where we are on the scale of being net long or net short for the different groups. It really will give you a good overall feel of how the markets are trading and what possibly might be around the corner. For this reason, I believe that viewing the COT in a chart format is extremely helpful. So remember, barchart.com is where you would go for that, because it'll show you where were the large speculators last month or 2 months earlier, and you can see, are they getting longer, are they getting shorter, are they at a position that exceeds what they normally would be. And to reiterate the fact that everything is relative, remember that example we were looking at in the euro, where 100,000 contracts in 2011 was considered extremely excessive, but in 2015 it really wasn't excessive until we got to 200,000. So things change. You can't write down a rule and expect it to always work. The markets change, things change. You have to keep up with it. Also, from market to market, the net long or short positions can be dramatically different. In the euro, we just talked about, it takes over $200,000 net contracts to have an overheated market, or at least the potential of one. In silver, it might only be 40 or 50,000 contracts. So you have to know which market you're looking at and what the norms are. And one thing that I really like to look at is if we see large speculators shifting from net long to net short, or vice versa. That can be pretty significant, because that's showing possibly a budding trend. So large speculators at that point, it's not like they've thrown all their money at the position. They're just starting out. And so sometimes that can be one of the best clues as to a trend reversal or a trend change. Well, Warren Buffett once said, be fearful when others are greedy, and greedy when others are fearful. And that is basically the essence of the COT chart in a nutshell. When the large specs are getting greedy and they're too long, that's when you should probably look at possibly putting a strategy together that could play the other side. When others are fearful, and let's say that, for example, in gold, a couple of months ago this actually occurred, the markets, speculators are almost always net long gold. It doesn't matter what's going on, they're always long gold. But sometimes they're less long than they normally are. Well, a couple of months ago, speculators were basically down to neutral. They had liquidated all their net long positions that they had accumulated from 2008, 2009 through 2011, and it's all basically just been washed out, and they're sitting on a neutral position. Well, I think that's a pretty good example of be greedy when others are fearful. The diehard gold bulls had given up on the market, and that's probably exactly when the best time to get bullish is. And since then, we've traded overall higher. I mean, it's been choppy, but it's been generally moving higher. The biggest advantage of the COT report, even if you're not using it to time entry of your trade, hopefully it just keeps you out of trouble, keeps you grounded, and avoids you being part of the overcrowding. Monitor the COT data might help traders from following the herd to slaughter. Overcrowded trades are basically miniature bubbles. They're irrationally exuberant, and we've all seen it. They can continue to excessive extremes, but undoubtedly it ends horribly. Does anyone remember silver a couple years ago? There was a magnificent rally into the $50 area, and it did nothing but crash from there. I don't know if crash is the right word, but you get the picture. Okay, we're going to look at a couple of examples of large speculators overcrowding. And I find this quote particularly interesting by Sir Isaac Newton. I can calculate the movement of the stars, but not the madness of men. We've all seen it. Markets get out of hand. The speculation gets out of hand. People go from thinking the world's coming to an end to the opposite in the blink of an eye, and it just is how the markets are. And I don't think they'll ever change. Markets will probably never be completely rational, and that's probably what keeps us interested. This is a good example of what the COT report could have done for traders just this year. In middle to late 2014, as we know, crude oil was trading above 100, and when it broke through, it was completely ugly. But before that instance, the COT report really was trying to tell us something. right at the point that the market broke down, the crude oil market, or at least the crude oil futures market, had the largest number of net long speculators in its history. So never before in the history of crude oil futures had people been that long. And that should have been a good indicator that it just simply wasn't a time to be bullish crude. All of those long traders had a decision to make. They could either stay long or they could get out, and as we all know, they got out. And when they got out, the bottom fell out from underneath the market. Now the interesting thing is the complete opposite thing happened. Well, not the complete opposite, but somewhat opposite. The thing about crude oil is speculators are almost always net long. It's not like some of the other markets where speculators will go from long to short, back to long, back to short. In crude oil, they're almost always long. So the fact that they went from a 480,000 net long position in 2014 down to a 200,000 contract position in early 2015 was significant. We hadn't seen speculators that, they're not short, but that least amount of long, I should say that meagerly long is probably a better way to put it, for basically since 2013. So we're talking, once again, the COT report clued us into, hey, speculators have liquidated a big chunk of their position, and it's very likely that the selling might dry out, and it did. Here's an example of what it might look like on a COT chart when speculators are doing what potentially could be the wrong thing. In mid-September of this year, just last month, small speculators were too long the S&P. Now, of course, at the time, a lot of people might have said, well, they're not too long. Well, who's to constitute too long? And now that we have the benefit of hindsight, it's a lot easier to say these types of things. But the truth is, they were too long. We actually pointed this out in a couple of our newsletters that after that, the big crash in late August, small speculators jumped in. You can see right here on the blue line on the bottom right-hand corner of the chart, as the S&P crashed, the small specs thought, hey, I'm going to buy the dip because you know what? It's been working for years. Small specs have just been trained. They buy the dip. They make money. And they weren't shy about it. They started buying in late August, and by mid-September, they had really loaded the boat. In fact, they were holding the largest net long position in the history of the E-mini S&P. And right about the time that they had loaded the boat is exactly when the rally stalled, and we came back down and retested the mid-1800s. So sometimes when you see the small speculators getting extremely aggressive, it's kind of a clue, a contrarian indicator. And you'll notice at the same time, if you look at the green line on the bottom right-hand corner, those are the large specs. And while the small specs were getting longer, the large specs, who are supposedly the smart money, were getting shorter. So this type of divergence also is an indicator of somebody's going to be wrong, and most likely it's going to be the small specs. And remember, they're fickle and they cover easily. So as many suspected, the large speculators were right. The market came down, they made some money, and the small speculators were forced out of their positions, but as they were selling, they were putting downward pressure on the market. So anyway, to recap what we've talked about here, the COT reports are issued by the CFTC, and it can be helpful in predicting future price moves, but should not be followed blindly. It's a tool, not a holy grail. Also, the COT data is relative. Be sure you're comparing it to history or to other markets. Know what you're looking at. It's not an absolute signal. And don't overanalyze the COT data. Use it as an overall gauge and then move to the next indicator. Like we mentioned before, the CFTC puts out several versions of the report, and it can get extremely complicated. But what happens is people get analysis paralysis. There's just too much information and too many quirks, and quite frankly, it just gets confusing. So we like to keep it really simple. And the bottom line is, hopefully the COT analysis can save you from the wrath of being in an overcrowded trade. So if you're interested in learning more about trading commodities, whether it's futures or options or currencies, My books are available on Amazon. They're actually available anywhere, but Amazon's the cheapest. If you have any questions at all, feel free to give me a call or send me an email, or you can just ask here in the next, I think we're going to open it up to questions here in the next few minutes. So if there's anything I can do for you, let me know.
All right, so if you got any questions, again, this is Dave Mecklenburg. If you got any questions, please type those in. Well, most of the questions we had typed in here weren't quite questions, so I don't have anything to ask yet. So, all right, so some questions coming in here. Someone's asking about seasonality. Are there seasonal effects to the COT report?
Generally speaking, I would say, I mean, there's definitely seasonalities involved in commodities. I've never really thought of it in that it affects the COT report directly. I've just always thought of it as affecting commodity price, but I guess if you think about it, they're all kind of tied into one and another, because a lot of the seasonal patterns are based on hedgers that have to do certain things in the markets at certain times and speculators that are anticipating those hedgers doing those things. So I guess it does kind of definitely plays a part. I think it's all tied, you know, they're all tied together. I'm not sure that you could add any sort of seasonality filters or anything like that to your COT analysis to improve it. But then again, I haven't really given it much thought either.
Are there indicators around for this? Just looking at my own trade station, I noticed there is actually a COT net position and total position and total position percent built in.
There are, yeah. Some platforms have it, some don't. My favorite platform that has it built in is Track and Trade. We actually offer it at our brokerage. It's called TNT Live, and you can sign up for a free trial on our website. And one of the plugins they offer is COT, and it's pretty awesome. It'll chart the COT stats right at the bottom of the chart and just make it really super visual. So also, like I mentioned on barchart.com, it's just an easy, free way to get it if your particular platform doesn't provide it.
Okay, I'm going to assume that most platforms that people pay for, it's going to be built in. It's just, you know.
Yeah, I would say I would venture to say that I don't know of a free platform that has it, so I think you're right about that. But even the paid platforms are kind of hit and miss. I only know of a couple that offer it, so it's not necessarily extremely available.
Well, like I say, I was just looking at TradeStation. It looks like it, it didn't quite give the information you gave, or if we want to pull out just the particular, look at the big guys there.
Right.
It wasn't quite giving that to me as an indicator in a chart. So.
Yeah, I don't know. I'm not familiar with TradeStation. Again, TNT Live is fabulous when it comes to COT charting. So if you're interested in something that's real convenient, trading platform and charting, that's a good one.
All right. Have there been any recent changes to the COT report? Changes in how they do it, formatting that could affect historical data?
If you're talking about just the simple format, like the answer is no. They have, started doing making it a little more complicated with the long format and adding different columns and all this kind of stuff. But I think it's more of a confusion than a help to most traders. So as far as the simple COT report, it's been the same forever since the beginning. And so no, I would say there's probably not any major changes, no.
All right, looks like we kind of run through these questions here. I want to remind you can find Carly here at thecarlytrading.com. There's the link. I'll also put a link in the recording, and that recording goes out 1 hour after we finish this. That's just the way GoToWebinar works. Take me a couple of minutes to process these videos, but GoToWebinar sends out everything kind of on the hour after the event ends. So you get that in exactly 1 hour. And, and then again, if you have any questions, of course, you can email Carly directly. Are you speaking at the Traders Expo next month?
I'm not, no. Or at least as of now, I'm not planning on it, no.
Okay, so sorry about that. I should have checked that ahead of time, but just in case you were going to be there, I was going to say, hey, and you can also find us in Vegas. Most people a lot of the speakers I have on right, typically speaking at that event. All right, so guys, I want to remind you that, again, we do these events a couple times a week. The next event is going to be Wednesday after the close with Andrew Keene, 30 minutes after the stock market close. And so make sure you register for those events. Again, you have to register to get the recording. And again, we will see you guys at the next event. We want to thank Carly for joining us today. Thank you.
Thanks a lot. Appreciate it.
And again, guys, look for that email in exactly 1 hour from Pro Trader Strategies with the link to the recording. Thanks a lot, guys.